Hello, and welcome back to ClearCast, the real estate fintech podcast. I am Jeff Allen, joined as always by my colleague and friend, Kenon Chen. Kenon, how are you?
Happy holidays.
Happy holidays.
Yeah.
This is episode 23, and it's a very special episode for multiple reasons. First, it's our end of 2021 episode.
Thank God. We've made it.
You made it. Slightly less crappy than 2020.
Our standards are really high.
Standards are very high. The other reason it's a very special episode is we're actually going to be joined for the entirety of our episode by Julian Hebron. Julian, welcome to the podcast.
Thank you. It's so great to be here with you guys and honored to help cap the year.
Yeah.
Well, we are honored to have you here. For those who don't know, Julian is the founder of The Basis Point. And The Basis Point is a sales and strategy consultancy to lenders, fintechs, and really focused on advising companies who are reinventing banking and real estate. Those of you who listen to this podcast are probably in our industry and attend industry events. And so you're very familiar with Julian's face and Julian's voice. He is consummate panel participant and often makes them a lot better through his presence.
Absolutely.
Thank you for that.
So normally, Julian, we would get into some detailed news stories for the industry to start off an episode, and there's no shortage of them. It is that time of year, which is the 2021 industry prognostication crystal ball article time of year. The content mills are churning them out. And there's lots of good articles we could talk about. We could be talking about what's going on with prognostications from NAR, from MBA. But we decided we've got the industry's best crystal ball with us here in you. So we're going to ask you for some thoughts on what are the major themes you see coming for the industry in 2022.
Love it. See if I can read the code, so to speak. I'll rephrase the crystal ball analogy,
right.
Given the monumental pop culture event that we have this week with The Matrix coming out.
Yes, I'm so excited for that, but I will not get distracted by talking about that. But yeah, I mean, one of the things we're seeing right in all of these articles is what's going to happen next year from an economic standpoint. We've got rising inflation. We have the Fed signaling that rates are going to, be increased at least, maybe 3 times next year. We've got a shortage of supply, and I think in every industry there's a shortage of supply, but certainly in housing. You're really good, Julian, at just breaking it down for people, especially for lenders, to say, all right, what does this really mean to me? How should I think about this? So what do you think? Break it down for us.
Yeah, sure. And Jeff, you said, you mentioned a few different forecasts, and it's important for all of us who take this seriously we all look at all the forecasts, right? And then a lot of times there's a tendency to say, well, let's prognosticate as opposed to let's look at what's available for the marketplace. So I tend to try to zoom in on that for the lending community because it can get lost in the headlines. And I think we can all agree it gets noisier over time. I think great quality programming like you guys do actually helps decipher some of the insight from all the noise, but it gets noisier. And so you're like, oh, well, lumber's up. So, I'm going to have less consumers to serve this year. I disagree with that. So maybe we could do a quick hit on home sales total and total mortgage units. And then maybe we can talk a little bit about inflation for a second too, because I do think it's important, especially as you educate consumers on what that means for them, right? But it's simple to me. Let's look at the addressable market for lenders, right? So if we distill a handful of the consensus estimates from the big investment banks, some of the industry groups, Jeff, like you said, it kind of boils down to roughly 7.3 million total home sales in 22, right? And approximately 87% of those are going to be existing and 13% are going to be new. And the median price of existing is approximately 360 and the median price of new is approximately 400, right? If we just distill those numbers alone, you're like, great, we've got 7.3 million home sales. Those price points at 360 and 400 don't scare off the majority, if you will, of, say, the middle class. And so that to me cuts through a lot of headlines, because it's like those numbers are doable for anyone. And if we take it one step further, let me rephrase, for anyone, there's doable for any consumer that is an aspiring home buyer and has been thinking about this for a little while. I'm not meant to make some broad statement that's somehow exclusionary. I'm just saying that those numbers aren't so high as certain alarmist headlines might suggest, that the industry is going to all of a sudden price itself out of being an industry, right? And I would just add this. So 7.3 million home sales total, but purchase units total estimated at about 4.83 million next year, right? Because we know that the difference there is the cash sales. But the point is that you got 4.83 million loans for everybody to do next year purchase wise. And then on top of that, you have another 2.3 million refis next year. So, 7.1, almost 7.2 million units next year. Things are going to be looking pretty good for the industry. And I just think that that's the only thing that matters. That cuts through every headline. And by the way, that embeds all of housing starts and all of the data that goes into the estimates for low inventory. So low inventory is not the headline. The industry is going to do 4.83 million purchase units and another 2.3 million refi units, and that's robust.
Yep. That's the thing we all need to keep our minds on, is there is a lot of business out there for people to execute against. And that kind of leads us into our second theme. There is a lot of business out there, but there's also a ton of new M&A activity and investment activity happening. So there's a lot of new businesses being created with lots of funding, lots of companies coming together in new ways. What's been driving that trend, and what do you see coming forward in M&A for 2022?
I'll do a couple words. Market share, the quest for market share is the overriding theme around M&A always. But that cuts across this sector that we're so intimately involved with, mortgage specifically, but it's now much broader into the broader fintech sector as well. So I want to talk about that for a minute, but if it's okay, before we go on, I think it is important to sort of touch on one more thing about where's the consumer in all this? Like, where are the lenders? We know what that lender opportunity is, but where are the consumers in all this? They're seeing all these headlines. Kenon, going to the idea that we have talked about in the past about like bidding wars. Mm-hmm. Bidding wars kind of went national. It became a national phenomenon. You guys are not too far from the Bay Area. I live in San Francisco. I know that the core markets that your firm came up with is quite familiar with markets that have always had bidding wars, and have had to deal with that from a collateral standpoint. As have I. But those numbers are, I think they are starting to normalize. I mean, if we just look at Redfin as a proxy for the market, I think they have a good data set, but bidding wars peaked out at 75% in May. We're now down to, effective with the latest report that came out this week from them for November, down to 59%. Being down to 59% of deals experiencing bidding wars is still very high, but the trend is moving in the right direction. And the education, if you combine that with all I see are inflation headlines as a consumer, I know that it's expensive when I go get gas or go to the grocery store. And confidence wise, I'm like, I don't know. But we know that the whole industry is kind of predicated on debt to income ratio. Credit score is a given. LTV is a given once you understand what cash somebody has to work with, right? But debt to income ratio is the most important thing. And I think that when everyone's trying to be the media and lenders are like maybe communicating about, hey, look at this inflation headline, it's the wrong message. The right message is, let us explain to you how we make loan approvals using, dividing your income by your debt.
Yeah.
So sorry, forgive me.
Yeah. No, that totally makes sense.
But it's just, these are the things that people can relate to way more so than, by the way, stocks or blockchain or some of the things that consumers are interested in. But it's like, here's a ratio and here's how we calculate how we approve your loan. And when you measure that against any extra spend that you might have in the current economic environment, it's all pretty good. You're not gonna be priced out. Those don't make headlines. And for lenders that can have the ability to communicate in that way and sort of, if you will, be the media, to me, that's the overwhelming message that lenders should focus on in the new year to counter all these crazy inflation headlines, right?
Yeah.
So I digress a little, but I didn't want to necessarily move off that last topic. But if we want, we can now do M&A.
No, that was great.
Yeah.
I think it's important we keep the consumer at the forefront of our thinking with this. And so I'm glad you did bring it back to that.
Yeah, it's that's what it's about. And all your listeners are very, very good at this. But I think even all of you listeners are susceptible to needing to field this barrage of people forwarding them a CNBC headline about inflation, being like, I can't afford this, and rates are going up. And it's like, rates are 3 1/8, right? That's not going to impact DTI that much. Your food and gas costs are not going to impact DTI that much. That's all I'm trying to say.
I do like to complain though. I do like to complain at that I think I pay like $5.30 at the pump. It's just
it is.
But yes,
yeah, but that's, Kenon, I think that's such a critical point because everyone does. I do it, and it does get in your head, and then you're like, maybe we should pause a little bit. And when all the lenders out there are thinking about their purchase pipelines for 22, you got to get in front of that. That's all I'm saying. And DTI is the easiest message in the world to get in front of it with. So, M&A. All right. I have a fun way of maybe doing this with just some real news headlines, because we can integrate the news headlines. I don't want your audience who's used to having you guys cover current events, go without it. One that flew under radar as we kicked off December was SoFi chief Anthony Noto. For those that remember, SoFi was like one of the OG consumer fintechs, right? And they start with student loans, and they are now basically like a modern era JP in the making, right? So he said at an investor conference to kick off the month that they want to get into mortgage at the tune of around 1%, and said that they would be disappointed if they stopped at 1% market share in mortgage. So if I may, just for fun, if we go for things that are in the headlines right now, Better Mortgages in the headlines right now. They did $40 billion through the third quarter of this year. And guess what percentage of the market that is? It's 1%, right? So when you start to think about how dots might come together, pure prognostication or conjecture on my part, whatever you want to call it. But I'm just saying, when you zoom out and just look at how certain things may come together, that's just one of countless examples. I could give another one, which is, let's take Loan Depot, $1.43 billion market cap today, and they are on pace. They did $107 billion through the third quarter. Okay. If they kept that pace, that's $140 billion for 21, $140 billion in fundings. They are a monster, and they know exactly what they're doing in mortgage, and they have a $1.43 billion market cap. SoFi has a $12 billion market cap. Right? The list goes on and on and on. If you start taking a look at the valuations of the fintech companies that are like, and Anthony Noto at SoFi is it's the first really line in the sand that I've heard as we move into the back half and the closeout of 21, that these fintech institutions are like, oh yeah, I guess we do need mortgage because our young customers are going to mature into that sooner than we thought. And they have valuations very much unfairly and unlike the mortgage sector that we're used to. All of our non-bank friends and family in this business know how to do this at scale, and mortgage just has never been a valuation business. It's a cash flow business. And the fintechs now have these valuations. And so that's just one. I think, Jeff, to your question, there's definitely going to be more deal making within the sector itself. But I just wanted to kind of offer that note of, again, how certain dots come together with the broader sector, because the rest of the fintech community is not one that our friends in the core of the industry always watches closely, because everyone's busy being great at doing loans. So I just wanted to offer that.
I mean, do you think that, I mean, that's super interesting from a merger standpoint and kind of what's going on. Are there any, though, I mean, new funded sort of, startups, entrants into it that you think are going to gain a ton of momentum, especially knowing that, the cost of money is going to go up, right? I mean, are we going to see these huge $70 million, $80 million, $100 million rounds as much in the lending space?
In the lending space, probably not. The odd thing about VC is that VC is the source of all optimism, and it's a really important part of the broader machinery of all of fintech and banking and lending and housing, because you have to have the deep-pocketed eternal optimists. I think it's easy in our industry for everybody to be cynical and be like, man, they don't know what they're talking about. This is so much harder than it looks. And I agree with all of that. I know how hard it is, right? We all do. But it's nice to have that. So while I would say that like a lot of that late stage VC and even PE activity, you look at the numbers and you're like, how could they keep going? They sometimes find a way to. But I don't think that the way that Wall Street, which I would categorize VC and PE firms as part of, look at all of this is, again, that core mortgage is too cyclical to ever have a big valuation, which is this odd phenomenon. And so I don't know that it can justify $100 million plus rounds unless you have a much broader, we're going to serve the consumer across all of the parts of their wallet. So we live in the borrow segment of the wallet, if you will, but there's four that the basis point kind of categorizes it: budget, save, borrow, invest. And then within borrow, as we know, there are several categories, of which mortgage is one. It's the biggest, but that's where credit cards go, and that's where personal loans and student loans and auto loans, and now buy now, pay later loans, which is the hottest thing going in fintech. But that's what gets the valuations. Sorry to go off, but I'll give you one more example that just pops my eyes when I look at it, which is so Affirm, which was founded by one of the original founders of PayPal, who, the PayPal mafia, right? They have a market cap that's north of $30 billion, right? And they're buy now, pay later. That's the thing when you go on a website and you're like, break this into installments.
Mhm.
That's just, not to oversimplify it, but that is just a modern take on a credit card. And Equifax, another interesting headline, this week has announced that they're going to start actually scoring it, right? Finally, the basis point had reached out to the New York Fed that tracks all the consumer debt, and they have a category called other. We've been asking them for a year, is buy now, pay later in that category? And the answer is not really. But also the CFPB, and maybe this is in its segue to another segment we wanted to do, opened up a massive inquiry into buy now, pay later just in the past week also. And so they're going to find out, just like we all found out in the post-Dodd-Frank era, just how serious regulators are. And Kenon, maybe those valuations temper a little bit, or maybe the investment community still thinks, hey, as long as you're diversified and you're not only in one product, you're good. I wouldn't make any other comments beyond that until we saw what, say, using our SoFi example, let's pretend they bought a meaningful mortgage organization to get to their 1% overnight.
Yeah.
Would that weigh down their valuation? Until I see that play out in the public, not the private markets where VCs get to set their own valuations.
Mm-hmm.
Until I saw it play out in the public market, I would reserve any further comment.
So let's go ahead and actually stay on the consumer for a second, because I think, you already went over for the numbers for next year. The focus really is on purchase, right? Like that's, we're going to see a decline in refis. So most of the market is going to be driven by purchase. And we had an interesting chat earlier on the role of IMBs in really, helping with buyers versus kind of, power buyers. And there's a lot of new players kind of getting involved in adding some of this sort of, certainty up front and bridge loans and stuff. So let's dive into that a little bit.
At my company, we talk to a lot of the investors at all stages, but late stage investors have become increasingly, have become increasingly interested in some of the power buyer models. And it definitely has legs once you start doing unit economics on it. But I want to put this into terms that this audience that's listening can really truly understand. TBD approvals and bridge loans have been a thing through all market shifts, all pivots back to purchase for the last few cycles. And if you measure TBD approvals plus maybe some bridge financing against power buyers, the IMBs generally powering the former and knowing how to do it very well. I'm going to bet on the IMBs, always bet on the IMBs through full market cycles. All of the mortgage banks and lenders and brokers know how to do this. And for those who maybe aren't as up to speed on every single term, TBD approval just means an actual underwriting approval that goes, instead of happening with you the production team, or at the branch level, or with the processor doing a really great pre-approval, including a run on DU or LP, it's actually going to an underwriter. This couldn't happen in the last almost 2 years because it was all hands on deck for refis. But as those refis clear out a little bit, every great lender knows how to do purchase market business, and you do TBD approvals. And then the big thing is, well, where's my cash to close going to come from? I got to sell my house. And that's the primary pitch that goes into sort of this power buyer model for some of these startups that, again, the eternal optimists, in a good way, I don't mean that as a pejorative, in the VC community really like and will fund. The problem is that what's the end game? If you're receiving $100 million plus rounds, a few of them to kind of scale a model, what do you think's going to happen? You can't just run that. That can't be your only business line. So you got to go deeper into traditional mortgage across the board, and then you look just like the IMBs in the end. So that's why in a purchase market transition, Kenon, you made an interesting point when we talked this out as well, which is even if the power buyers turn out to be the next gen of all the big mortgage lenders, so be it. How long is that going to take? It's going to take a full market cycle. So, but nevertheless, I think as always, our existing lending community will prove extraordinarily resilient in terms of being able to allow consumers to write cash-like offers by doing it the way they've done it in past market cycles. I know that sounds super old school, but it is what it is. It takes a long time to get good at doing this, and every one of your listeners knows that.
Yeah, that's super cool. Interesting.
Another thing that takes a long time to get really good at is dealing with ever-changing regulation.
Yes.
It takes a long time to get good at it, and deep pockets and lots of lawyers.
That's right.
And it seems like there's been a bit of a pendulum swing here recently, in that, enforcement and regulation are going to start to be back on the table in a bigger way. What are you seeing in that space, and what should lenders be expecting in 2022?
I don't want to tell lenders anything they don't already know. I might just put it into words that maybe validate and underline certain things that you're all thinking about already. But I think 22 is the year that regulation through enforcement ramps up. What do we mean by that? Regulation through enforcement was this label that some of the very strong and critical advocates in our industry groups and so forth gave to this idea that in the post-Dodd-Frank CFPB era would come and issue enforcements, issue by issue, right? No matter what it was, in terms of the things that they wanted lenders to pay attention to. So example, loan officer comp also changed as a part of Dodd-Frank. So you have loan officer comp being something that then the CFPB is watching at the time, and they issue an enforcement to a certain company. That enforcement comes with a consent order. Instead of sort of referring throughout that consent order it definitely refers to laws throughout, but it more so is like, we have sole discretion to come after you. We have review of your balance sheet. We, the regulator, have review of you, the lender's balance sheet. We'll issue an enforcement that's going to hurt bad, but is not going to level you. And then we tell the industry that every participant in the industry better be reading every consent order. And all the advocacy groups at the time were like, why don't you just make the law the way you want the law to be, instead of saying regulation through enforcement, like you're regulating through these consent orders. I think that with industry moving as fast as it does, I don't know that changes. I think that when I say regulation through enforcement ramps up, the CFPB under its current leadership has sent crystal clear messages about that's pretty much what we can all expect, and everyone listening knows that, right? So I just think that anyone who isn't taking it seriously really needs to take it seriously. There's one that I was very intimately involved with, making one of the toughest decisions of my career at the time, that had to do with joint ventures. There was an infamous memo that came out. That wasn't even a consent order. That was just a memo that came out from the previous CFPB director, Richard Cordray, that basically just said in very clear language, we don't like MSAs. They didn't make a rule against it, but they said that they seem designed to evade critical components of RESPA. I was running San Francisco's largest joint venture at the time between a mortgage bank and a real estate company, and we voluntarily shut it down within 1/4 of that coming out, because we just, and these are the decisions that all your listeners have to make, and they are gut-wrenching. And I just think that method of regulation is the only way regulators can keep up with how fast things move. The one thing I don't like about it, it's a reality. So it's not like it doesn't matter if we like it or don't like it. It's just, you better be ready. But one thing that I I just wish wasn't this way, was that I do think it stalls RESPA modernization. What do we mean by that? Like one-stop shop stuff, right? Can I own a title company, and can, if we look at, say, let's look at like Compass. Compass is a big public real estate company. They have this deal with Guaranteed Rate for Origin Point, which is their joint venture with mortgage. It's that kind of stuff that those are great, smart deals that are legal under RESPA, but in a regulation through enforcement era, we could imagine that they're going to be tested in some way. So, Jeff, to your point, organizations with resources can hopefully turn this into meaningful dialogue between industry and regulation in a way that's productive for the consumer.
Yeah. I was thinking about how, we're already seeing, of course, as well, other agencies, not just the CFPB, but other agencies, working together on the topic of, fair housing, bringing the Fair Housing Act back to the forefront, and of course that affects some conversations we've had around appraisal, on this podcast, and certainly, in our day jobs. But multiple bulletins are starting to go out, kind of saying, hey, this is something that we're taking a look at. This is something we're advising you on, even though we haven't set necessarily a new policy yet. So we're certainly seeing it in our space as well. So that definitely makes sense.
And I would offer one note there. You guys know that space. That is space that I would just sound dumb if I started treading into the space that you guys know so intimately. But I will say that I do quite appreciate the general tone and the objectives that I can seem to glean from Director Thompson at FHFA as it pertains to how inclusion, as it pertains to removing bias from valuation. I think these are super critical topics that I know that you guys are very intimately involved in, and it so far seems that the tone is regulators are regulators. I was told that face to face by a CFPB regulator during an audit back in the Cordray era, where I'm like, we're doing our onboarding meeting. Look forward to collaborating. We're not your collaborator. We are your regulator. I only needed to hear that once. With that said, I do feel like the leadership of FHFA seems to want to really understand what's important to make progress in the industry, and valuation is one of the big ones. So I keep my fingers crossed on that.
Yeah, especially as it leads to, modernization, digitizing the process in a way that has benefits to consumers, and which is a good segue, I think, into our final theme here, which is, through COVID, we've seen an acceleration of digitizing other aspects of the mortgage process, and like I said, appraisals finally starting to, I think, catch up to that as well. But what do you think is left? What's the gap in digital origination, digital mortgage, and where are we going to go in 2022?
I think and hope that 22 is the last mile of digital originations, and the extracting data from docs has proven a tougher nut to crack than we all thought when the POS wave really began in 2012. We know that the launch of Rocket Mortgage a few years later was, if you will, the line in the sand on mainstreaming the concept of the POS, but it did really begin in 2012. But we also know that most loans still have paper, approximately 3/4 of them. And it's taken this long to not figure out OCR. And this stuff all goes by like different labels now. It's like machine learning and machine reading documents and AI and the fancy terminology that goes into it. But long story short is, if you can't sell those loans, you're going to do it the old-fashioned way so that you can sell those loans. And I think that technology is finally getting there to bring us through that last mile to where you can legitimately say, this stuff over here is direct to source in this file, and this stuff over here just has to be paper. It just is what it is. But we now have the ability to move much faster in 22 on turning that digital at the point of capture. And I think and hope that that proves to be true in 22. Maybe we do this a year from now. We'll see how we do on that. But that's my hope. That opens up a critical theme, in my opinion, as it pertains to, I think there's been a ton of progress in servicing, but servicing, like, consumers are now like, wait, I had this wonderful, like, I did my loan on my phone in originations, and finally now servicing is gonna get there, and it's related. It's the same technology, and you finally have enough momentum in the servicing community and the servicing fintech community that says we can get the consumer experience there. So that's that. But then lastly, and this is a much bigger one, Jeff, I definitely try to stick to themes if I am going to make public remarks at conferences and stuff. And I'm sure some of your audience has seen me chirping about blockchain. And I think that it's very easy for a lot of your listeners who are very seasoned, super smart scale lenders to kind of roll their eyes on blockchain. But this bit that we just covered of, like, if you can get a truly digital file, not what we've been dealing with up to now, but getting all the paper stuff digitized, that is the prerequisite for blockchain to become real with first lien mortgages at any type of scale. Mm-hmm. So that's maybe a whole, like, episode, but I will say that's something that I'm watching for. If you can get to truly digital, including the docs that can go digital, you can have much more productive conversations about first lien originating on blockchain and staying on blockchain through servicing and securitization.
So that probably is its own whole episode, but if you can spare us a few minutes to dig a little bit further on that, because I think it's a topic Kenon and I are both very interested in. There's a ton of energy around blockchain, and not just in mortgage, but just the whole movement seems to be attracting a lot of really talented and creative people. Right. So it really feels like there's something here with blockchain, but we're still trying to connect the dots, like, in a very specific way of, like, what exactly is blockchain going to unlock for mortgage? So if you had to answer that question in the Cliff's Notes version, What is the answer?
Yeah, I think I can do it briefly, which is, the industry is all predicated on trust but verify, right? That's, like, everyone says that. Like, yeah, we get it, but, you know, if you take that down to the consumer level, like, great consultation, I just learned everything about you, and now we're going to take, 20 to 40 days to verify it all and put you through hell, right? And then we'll close your loan. Like, that's how it works on the ground. So, and that's trust but verify. Of course we trust you, and we want your business, and we are going to earn it. But the phrase that in the blockchain community, that's something that is sort of the antithesis of that is just, it's the first thing everyone in the blockchain and crypto community says, that, Jeff, to your point, that knows, not people running their mouths, but people that get it. It's a version of that, but it's replaced trust with truth. What does that mean? That goes to everything that we just talked about. If you're replacing trust with truth, that means that you went direct to source for all this part of the file, and you were able to get all these documents digital native for this part of the file, and you have a full file. If you don't have that, you can't even think about blockchain being a thing. But if you do, then you can take it from origination through securitization. Because think about what happens in origination. You have warehouse, right? So with warehouse alone, you have to, like, do another round of due diligence and QA on that. But then when you're going to sell the loan, whether it's Fannie or Freddie or any PLS kind of sale, whole loan sale, you're securitizing, whatever it is that you're doing to move those loans, there's a whole set of due diligence around that. And you guys definitely know this from the collateral component of that, right? Yeah. There's third-party reviews up and down the line all the time. And what blockchain is meant to do is eliminate as much of that as it can. And there have been really good use cases around proving that you could wring out, over 100 basis points from second lien, like HELOC. But going back to my statement of like what the basis point is watching for in 22 is, can you prove with at least a few billion, somewhere between 2 and 10 billion in first lien mortgages, that you actually can show, Jeff, to your question, how you can wring out some basis points from origination through securitization? How many basis points and what are they? The reason I personally think this is interesting is because whether you're direct or retail, we can talk until we're blue in the face about the cost to do a loan. It's $8,000-ish, right? We've been talking about this through the entire POS modernization era.
Yeah, it hasn't gotten cheaper. Yeah.
Right? And why is that? The main reason is because of sales and marketing cost. If you're direct, it's mostly marketing. If you're retail, it's mostly sales. You have to have that. That's customer acquisition. I don't think that those come down. So you have to focus in on these basis points of all this due diligence that's happening up and down the line, from origination through servicing through securitization. That's the only way that you're going to have meaningful cost efficiency. I get that some people are probably rolling their eyes when they're listening to this right now, but I do believe that we are getting closer. We are definitely getting closer. And I do believe that in 22, we are going to see some first lien use cases, and everyone can continue to roll their eyes, or they'll be like, oh, wait, there's progress here. So sorry, that was a little longer than I intended, but hopefully that helps.
Dropping pearls of wisdom on the podcast.
And fitting that you have a Matrix themed background, and that the Matrix comes out this week, because I feel like I just took the blockchain red pill.
Yes, exactly. Well, we can go full red pill if you want on a future episode. Okay. Because it's, no, in all seriousness, and we won't do this today, but when you talk about e-notes, collateral, like there are, it's not just the borrower. Pretty much everything I just talked about was mostly about the borrower, but the true red pill discussion on mortgage first lien blockchain is about notes and about collateral, right? Yeah. So yes, we should do it again.
Yeah, that's where my head went immediately, was what does the collateral process look like on blockchain? Like from a process standpoint, what exactly is different?
Yeah. And I would offer this for now. And again, this is where I step more into your turf, and you can bat me down here. But I do believe that the tone that I mentioned coming out of FHFA under Director Thompson is very receptive to the fact that there is so much valuation data out there that they are willing, much more so, to consider that as part of approvals in general. This is blockchain aside, right? Yep. But they are just leaning more towards this automated value, being supportive of automated valuations. And if we are trying to, as we say in blockchain, replace trust with truth, the truth is out there with valuation. And the FHFA director has said this publicly, as you guys well know. So it's not to say that that's the solution. It is to say that it's very encouraging.
And the truth will set you free.
Let's hope it does, Kenon.
Well, Julian, this was an absolute pleasure. Thank you for walking us through your themes. And we wish you a happy holidays and a great new year.
Absolutely. You as well. And we will reconvene on how everybody appreciated the Matrix. Needless to say, my expectations are very high.
Oh man, thanks, Julian. Appreciate it.
Yep, absolutely.
news stories are so crazy.
So crazy.